Hello, this is Mark with Semantics Research with your daily report. So today marked the second time in the past decade that the Fed is attempting to do quantitative tightening to shrink its balance sheet. The Fed is signaling for a shrinkage of $95 billion per month as existing treasuries and mortgage-backed securities matures. It is likely that the lows are not in, and it is simply a bear market rally these past few sessions. And we must remember that with this in mind, there are high inflationary pressures, and with the credit market relatively stable and not so great economic data coming in, it gives the Fed incentive to increase hawkish behavior with uncertainty surrounding the next few inflation prints, with also the GDP number being very key. If the GDP number turns out to be negative, then likely hell will break loose, or the best case scenario, perhaps we will see waning growth. Either way, it does not bode well for the economy. It is likely that there will be a slowdown in growth at the bare minimum, and we do have to note that we have 100 basis points of rate hikes scheduled over the next few months. So I would say it's quite premature to call a bottom just yet, as many are trying to be a hero in the news media by calling a bottom, as evidenced by those on CNBC. As we opened initially on the US cash open on the ES, we did bid higher until the release of the U.S. manufacturing PMI, which did signal a slowdown amid cooling demand as well as surging costs and materials shortages. And at that point, we began making low ticks on the day, and we did break below the initial balance low. Taking a look at the U.S. manufacturing PMI, the manufacturing sector did signal further improvement in operating conditions in May, but the rate of growth was at its softest in output, new orders, and stock purchases since January. And this is due to many concerns of economic slowdown as well as inflation and supply chain constraints. There is currently a sharp uptick in the backlogs of work as firms are continuing to look to fill the long-held vacancies. It appears that the material costs and supplier delivery delays continue to hamper production, which lengthens the lead times to a greater extent. We do see manufacturers lowering their purchases to stockpile inventory as costs remain high, and instead they prefer to unload existing inventory. On the consumer side, inflation continues to dampen demand as manufacturers are forced to pass on the cost to the consumers by raising prices. The reason for this is because there are higher operating expenses due to price hikes in commodities such as metals and energy, which has been exacerbated by the Ukraine war and uneven reopenings. As we can see, at that point in the day, we did see the treasuries spike higher as well as the dollar catching a bid, which did soften the market. Although the sellers did fail to gain follow through to the downside at the technical level of 40.90 on the ES futures, we did initially poke below it, but we did reclaim it and had an afternoon rally high, which did reclaim the initial balance range. But due to the yields being rather high, it was quite difficult for the market to bid higher than the technical level of 41.30 on the ES, which did prove to be a very key resistance as it is a low volume node. If we take a look at the dollar, we did bid higher and continued seeing a flight to safety in the dollar. And this is likely due to recession fears. Another thing to note, interestingly enough, we did have a Vix contraction, which makes me question further significant downside. It is quite hard to have a market sell-off with that in mind. However, it's not like the VIX and SPY perfectly moves inversely tick for tick anymore like it did in the past, as it has a inverse correlation to a lesser degree, but I really seriously doubt any significant downside for the time being. We did have Lending Club, which is a fintech firm, state that they see 1/3 of consumers that earn $250,000 or more a year are beginning to live paycheck to paycheck, which does add concerns to its implications. With the JOLTS number, we did print super strong, but we do have to remember that the JOLTS number is delayed by 2 months, so likely the real labor market is quite abysmal. Yeah, we do have the Fed cornered into a bad situation with the economy appearing to slow, but the slower growth in the economy is not leading to slower price acceleration, which is a concern. The U.S. Atlanta Q2 GDP nowcast growth estimate was at 1.3% versus 1.9% previously, which was an estimate that is released before the official number. Do note that this model is based on mathematical results and does not capture the impact of COVID-19 and other factors. And at this point, it does put the Fed's credibility in jeopardy. And we did have Bullard speak today, and he did state that inflation today can be compared to the high inflation period of the 1970s. And if the Fed loses credibility, we can see inflation expectations become rather unhinged, which can lead to higher inflation and volatile economic performance. Although the past is not a perfect comparison, as the context is quite different, as back in the 1970s, the economy was less robust, with the U.S. steel going to downturn and Japanese auto taking over, and the oil embargo, which actually affected the U.S. economy quite negatively, as the U.S. was heavily reliant on oil back then. It is important to use these historical references as key references, rather. On a positive note, China is gradually opening up, so that is slightly positive, as it will, although it will create some demand for oil, as Shanghai is a heavy consumer of oil. This could ease supply chain woes caused by the lockdown, since the U.S. is heavily reliant on China for its supply chain. So, in conclusion, the Fed is attempting to deal with inflation, which has brought much turmoil to stocks, bonds, and even the housing market. It is likely we will see job losses follow later in the year and higher prices from inflation, which is causing demand destruction as consumers spend more money on gas, food, and goods. As the Ukraine war is prolonged and the reopening of China is likely to be rather slow, we are likely to see stickier inflation, as we already have been seeing broadening inflation to other categories in the last CPI report, which can in turn be very difficult to deal with. We are likely to see another set of price hikes in food, as well as farmers are reporting higher costs due to supply chain disruptions, bad harvest, higher fuel costs, higher equipment costs, and fertilizer shortages. The price hikes in fuel and food will leave Americans with less money to spend on goods, which in turn will kill demand and have a ripple effect on a wider economy. We are seeing household savings dwindling, as well as Americans are taking on higher credit card debt to survive, and I think many will be surprised by the greater than expected persistence of inflation. We did print the most money in all of history, with all these dollars chasing a limited supply of goods due to supply chain constraints, due to uneven lockdowns and war, which actually in turn creates a perfect storm. And that is it for today's daily report. be sure to check out the link in the description and follow us on Twitter for more future updates. I thank you all for watching and have a nice night. Thank you.